A supplier you rarely notice, powering everyday EVs and the big battery that steadies the grid. That's CATL. Based in China, it makes vehicle battery cells and packs, builds grid-scale storage systems, recycles materials, and holds selective upstream stakes to secure supply. We'll walk through the business, the tech choices that drive costs, the competitive landscape, and the key risks. Then I will keep the financials tight and give you my personal take on the stock. CATL makes three things that fit together: batteries for vehicles, batteries for the grid, and a materials loop that fits both. On the roadside, they manufacture cells and assemble them into packs for mainstream cars, buses, and trucks. On the grid side, they ship cabinet and container systems that sit next to wind and solar or inside factories to stabilize the power system, energy storage or ESS. Around those two engines sits BRUMP, the recycling arm that turns used batteries back into battery ingredients, plus a handful of selective upstream stakes in lithium and nickel. Those stakes don't make CATL a miner, they are mainly there to secure supply and soften shocks when raw materials swing. Before we go further, anchor the scale so the rest makes sense. In the latest year, roughly 70% of revenue still comes from EV batteries, the mid-teens from ESS, single digits from materials and recycling, with small slices for upstream and other. Geographically, it's about 70-30 between China and the rest of the world. How did CATL get here? Things cause and effect, not just dates. The company starts life in 2018 as a spin-out from ATL, Amperex Technology Limited, known for small batteries for phones and laptops, so it could focus on big batteries for vehicles. That leads to the 2018 Shenzhen IPO and the first big European contracts. BMW is the headline, then Scale pays for R&D on how to package cells more efficiently. In 2022, they roll out Qilin, a cell-to-pack design that removes an entire module layer so the same outer box holds more energy with fewer parts. That same year, serial production starts in Germany, and a 100 gigawatt-hour plant is announced in Hungary. In 2023, Shenxing arrives, bringing fast charging to LFP, lithium iron phosphate, the safer, lower-cost chemistry used in many mainstream EVs. From 2024 onward, the European footprint widens again with a joint venture in Spain for LFP cells, while BRUMP scales up recycling to close the loop. Now, read that revenue curve with that context in mind. CATL's revenue rose from 30 billion RMB in 2018 to 362 billion RMB in 2024, about 12x in 6 years, driven by the rapid ramp-up of EV penetration. 2024 eased 9.7% year-on-year as ASP normalization and price competition outweighed resilient volumes, with the level still well above 2022. Now EV to revenue on 2024 numbers, 3.76x looks broadly normative for a scaled, cash-generative leader, not stretched. For Pulse, H1 25 revenue was 178.9 billion RMB, plus 7.3% year-on-year, with EV batteries plus 16.8% and ESS minus 1.5%, implying a run rate multiple trending closer to 3x as ongoing cash generation lowers enterprise value. And that sets up the how. What choices actually push cost per kilowatt hour down or back up, and why that shows up in margins? If you want to understand CATL's cost base, follow two levers that work together: what chemistry you choose and how you build the pack around it. LFP, lithium iron phosphate, is the workhorse, safer and cheaper with great durability, so it fits mainstream EVs and storage. NMC nickel manganese cobalt goes further on a charge, but costs more and swings with metals. LMFP, lithium manganese iron phosphate, sometimes called M3P, nudges LFP's energy up while keeping costs friendly. Then, design multiples the effect. With Qilin, CATL removes the module layer, which means fewer parts to buy and assemble, more usable volume for the same outer dimensions, and faster lines. Shenxing then tackles a practical concern: charging speed, by bringing fast charge to LFP. The headline claim is roughly approximately 400 km in 10 minutes, which lets mainstream chemistries cover more use cases without jumping to premium materials. All of this sits under tighter safety rules, especially in China, that push packs to contain thermal events and warn early. Because this channel is about numbers, put some cost markers on it. In 2024's reset, China LFP sales were often quoted around $53 to $59 per kilowatt hour, and some EV packs cleared under $90 per kilowatt hour at home. Global NMC sale averages sat higher, in the high $16 per kilowatt hour range. Regions matters too. Average pack prices were roughly $94 per kilowatt hour in China, about 31% higher in the US, and roughly 48% higher in Europe. That's why Chinese LFP from leaders like CATL and BYD is the benchmark on costs, and why localization is such a big theme for everyone else. Since sodium ion always comes up, let's place it right here in context. You'll see sensational claims online, those $10 per kilowatt hours posts. That's not today's reality. Early sodium ion runs are roughly $80 to $95 per kilowatt hour at the cell level, and a bit over $100 per kilowatt hour at the pack level, still above top-tier LFP in China. The upside: sodium cells can run on LFP style lines, so as yields and volumes rise, costs should fall. Until then, think promising but early. Now zoom out to profitability. CATL's EBITDA margin sat in the low 20s in 2018-2020, compressed in 2021, and troughed around 16% in 2022 as raw material spikes hit and pass-throughs lagged. It recovered to 20% in 2023 and widened to 25% in 2024 as input costs normalized, contracts repriced, and scale-ups improved. Net-net, margins are now above pre-spike levels despite 2024 ASP deflation, evidence of cost leadership, not just mix. Taken together, those economics explain why CATL leads on share. It competes through breadth, through scale, and through pack integration. Because it localizes, Germany running, Hungary building, Spain as a joint venture, that cost position travels outside China, reinforcing its lead. There is a general lesson behind that ranking. Technology choice sets your cost curve. The ACC episode is the caution. Start on a pricier chemistry and you look uncompetitive. Pivoting toward cheaper LFP type cells later costs time and money. In batteries, pick the wrong architecture at the wrong moment and you are too expensive, too late. Zooming out, the runway is still long. Against a strong growth backdrop, EV battery demand is expected to more than triple from 1 TWh in 2024 to 3 TWh by 2030, with grid storage adding a second engine toward approximately 442 GWh a year by decade end, approximately 21% CAGR. The real edge will be navigating policy and cycles. Trade and localization barriers now extend beyond the US-EU to Turkey, Brazil, India and others, which makes the practical playbook build where you sell and diversify customers so no single regime boxes you out. Near term, demand is lumpy. Europe cooled in 2024 and varies by country as incentives and affordable models drive uptake. Chinese brands will push into emerging markets, but charging networks and grid reliability cap the pace. And this industry is cyclical. When automakers slow, battery orders and inventories swing, and CATL feels it. With that in mind, and the caveat on policy, pricing cycles, and localization, we'll keep the financial read tight before I give you my view on the stock. EPS rose 7x from 2018 to 2024, slower than revenue despite stable EBITDA margin. The reason is dilution. The share count roughly doubled, so profit per share grew less. Even so, a 7x EPS gain in 6 years is exceptional. EPS jumped 33% year-on-year in H1 25 as higher battery shipments and margin recovery, lower lithium input costs, better scale, plus stronger financial income more than offset softer ASPs. PPE per share reached approximately 25.7 yuan in 2024 versus the 325 yuan spot share price. That's approximately 8% of the stock's value tied to hard plant and equipment. MC to tangible equity has reset from 17x in 2021 to 5x in 2024 and 6.4x now. i.e., investors pay approximately 6 yuan for each 1 yuan of hard equity, a premium that assumes CATL can keep compounding tangible book at strong, sustainable return on equity. By 2024, CATL is in deep net cash, about 134 billion RMB, cash 270 billion, debt 136 billion, with minimal leverage and strong liquidity, giving ample flexibility to fund capex and dividends without relying on additional borrowing. capex climbed from 6.6 billion RMB in 2018 to a 48.2 billion RMB peak in 2022. Then eased to approximately 31.2 billion RMB in 2024 as plants moved from build to ramp. As a share of revenue, it spiked to 33.6% in 2021, then fell to 8 to 9% in 2023-2024, signaling the heavy build-out is past and spending has normalized. Working capital flipped from plus 57 days in 2018 to a trough of minus 99 days in 2021 as scale and bargaining power drove supplier financing and customer advances. It stayed strongly negative in 2022, minus 71 days, then normalized to minus 25, minus 21 days in 2023-2024 as growth cooled and inventories receivables rebuilt. Free cash flow per share rose from 2 yuan in 2018 to 15 yuan in 2024, with a one-off dip into negative in 2021 when capex peaked. The price to free cash flow that blew out around that trough has normalized to the mid-teens. At today's price, 21.6x price to free cash flow is high side of normal, not extreme for a quality leader, but it assumes ongoing double-digit free cash flow growth. Return on equity doubled from 12% to 24 to 25% in 2022-2024 and held there despite a much larger equity base. Clear evidence of durable profitability and efficient reinvestment. Since the 2021 capex peak, CATL moved from zero dividend to a steady 50% payout ratio, with DPS rising across 2022-2024. At today's price, the dividend yield is 1.8%. Buybacks exist, but are marginal, about 0.3 to 0.6% of market cap per year. Today's price is about 325 yuan, around 50% below the log regression midline, approximately 384 yuan, with the -1 sigma band near 245 yuan. On reported financial year 2024 earnings, the stock trades at 28.1x P/E ratio. Swapping in H1 25 for H1 24 brings the multiple to 24.5x, still elevated but consistent with the group's strong growth profile. As a cross-check, a base free cash flow to equity DCF indicates 378 yuan per share, close to the regression midline. CATL is a global battery leader built on two engines: EV batteries and grid-scale storage. It won by producing cheaper and better at scale, with proprietary pack integration, Qilin, CTP, fast charge LFP, Shenxing, close supplier network, and a build-where-you-sell footprint that exports its cost edge. In China's ultra-competitive market, it has proved the best-run operator. The backdrop is supportive, EV adoption should keep rising as more affordable models arrive and charging networks improve. Governments still push electrification with fleet targets, incentives, and tighter emissions rules. On the grid side, storage grows because wind and solar need buffers to smooth supply and stabilize frequency. And finally, falling battery costs and faster pack design also open more use cases in factories and data centers. Put simply, demand for both vehicle batteries and ESS has a long runway. But risks remain. The business is tied to a cyclical auto sector. Competition and overcapacity in China pressure prices, and trade barriers can slow exports, though localization helps. Input costs still matter despite recycling and selective upstream stakes. On technology, sodium-ion is promising but early. Those viral $10 per kilowatt-hour claims aren't today's reality. And finally, on valuation, swapping in H125 for H124 puts the run rate P ratio at 24.5x. The regression midline and the base free cash flow to equity DCF both cluster around 380 yuan per share. With the stock near 325 yuan, that reads slightly undervalued. If the auto value chain interests you, CATL is a strong name to hold. The multiple may look high today, but it fits the sector's growth outlook. Keep in mind that at these multiples, the market tends to punish even minor earnings misses. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe and share this video. And if you are into consumer brands, check out my video on media, a quiet compounder with serious global reach.